If you have an unincorporated business as a professional, self-employed, or business owner, and you are looking for income tax tips to reduce your personal tax, then this is the right video for you. For individuals, the personal income tax planning opportunities are generally very limited. However, if you are a professional, self-employed, or you own a business, in a 3-part series, I have 12 income tax tips for you to cut your tax bill for your business income. These were the 8 income tax tips I had for you in my first and second part of this series. Tip number 1. Understand and maximize tax deductions. 2. Reduce meals and entertainment expenses. 3. Maximize home office expense deduction. 4. Maximize car expense deduction. 5. Deduct medical expenses. 6. Split income. 7. Maximize interest deduction. And 8. Avoid non-deductible convention expenses. This video is the last part of this series, and this is my 3rd installment of another 4 income tax tips for you. Tip number 9. Get government funding and tax credit. 10. Accelerate tax depreciation. 11. Keep complete and accurate records. And 12. Incorporate your business. Now, let's look at each of these 4 income tax tips in more details. Tip number 10. Get government funding to reduce your labor costs. For example, under the Ontario Youth Employment Fund, Ontario employers may receive up to $6,800 to cover the cost of wages and training for new hires when they provide a job placement of 4 to 6 months. Under the Canada Job Grant Program, employers may receive up to $10,000 per grant to cover 2/3 of the cost of employee trainings provided by eligible third-party trainers, such as community or career colleges or private trainers. The federal and various provincial governments also offer tax credit to employers for hiring eligible apprentices and co-op students. The federal credit is a non-refundable credit equal to 10% of the eligible wages payable to eligible apprentices. The maximum credit is $2,000 per year for each eligible apprentice. The Ontario credit is a refundable credit equal to 35% to 45% of the eligible wages paid to eligible apprentices. The maximum credit is $10,000 per year for each eligible apprentice. Tip number 10. Acquire a depreciable asset before the year end rather than in the new year. You cannot simply write off the cost of the depreciable asset, but you can claim a portion of the cost every year as tax depreciation. However, in the year of acquisition, only 1/2 of the tax depreciation you could otherwise claim for the asset will be allowed. As a result, acquiring an asset just before your year end will accelerate the timing of your tax depreciation. On the other hand, acquiring an asset at the beginning of the year will defer the timing of your tax depreciation. Tip number 11. Maintain and retain complete and accurate records of your income and expenses. Receipts are vital for validating your expense deduction. If it is not obvious, write down the purpose of the expense on your receipt. It is especially important to write down on the receipt for meals and entertainments of who you took to lunch and why. The CRA will likely review your expense claims and compare them to the norms of your particular industry to see if they are reasonable. A tax audit may be triggered if your expenses are found to be abnormally high compared to the industry norm. However, you should have nothing to worry about if your records are complete and organized. Tip number 12. If you do not need to spend all the business income you made, there may be tax deferral benefit of incorporating your business. The amount of tax deferral benefit will depend on 3 factors. First, how much income could be retained in your company and for how long? Second, what is your personal marginal tax rate? Third, what would be your company's corporate income tax rate? Generally, depending on the province of your company's operation, your company's corporate income tax rate would range from 11% to 19% on its first $500,000 of active business earnings. Let's look at an example. Say you are living in Ontario and earning an annual income of $400,000 from your unincorporated business. If you incorporate a company to earn the $400,000 business income, take out $250,000 as salaries for your own personal spending, and leave $150,000 in your company, for which your company will have to pay tax at 15.5%. The tax deferral benefit for leaving the $150,000 in your company would be approximately $52,000. Other than tax deferral benefit, there are many other commercial and tax-related factors to consider whether to incorporate your business. You should talk to a tax accountant before acting on this tip. As a recap, this is my 3rd installment of another 4 income tax tips for you. Thank you for watching. I am Claudia Ku, your trusted tax accountant. I hope you find the video useful. Share the video with your friends and your family if you think they can use the information. Let me know your thoughts or if you have any questions in the comment box below. And don't forget to subscribe my channel to watch my upcoming videos. Also, click on the link to my website to receive our free email service of tax tips. See you in the next video.